Fear and anxiety are everywhere in the marketplace today, and let's examine what's going on today with these unsettled markets and the fundamentals that should drive them. I think fear and anxiety are good things. Skepticism about these markets and the fundamentals that drive them help investors make better decisions. But how far apart are fundamentals from this fear and anxiety we're seeing today? Well, let's examine them. The first fundamental is, what's the biggest economy of the world doing, and what's it likely to do over the next several months? Well, the driver of the U.S. economy, which is the #1 economy in terms of overall GDP, is driven by the consumer. And what is happening with them? Their wages are rising, their work week is high, and the number of the workers in the United States continues to expand at a very steady pace. If you add to that, basic costs of living for the U.S. consumer are falling. Apparel, food, energy, as a percent of disposable income falling. This gives them more real buying power. This is an important element of how to look at the equity markets and interest rates. China, the second biggest economy in the world, and it's slowing down. It is for sure. There aren't any experts out there that I have talked to that say they're going to zero growth or recession, but they are decelerating. It's disturbing to the rest of the world. It's dislocating the commodities market. It's dislocating the energy markets. But what does it mean? It means that they are, because of demand, lowering the price of energy because they're not demanding as much. And energy is a big input cost for Japan, for the Eurozone, and for the US consumer. And now that input cost has fallen. That has helped depress the inflationary pressures around the world, and that's kept interest rates low. So now you've got two input costs to the whole production cycle, interest rates and oil, being lower than what we've seen in decades. This, to me, and we look at history, this tells us when these two elements are lower from a historic point of view, it tends to stimulate moderately world growth in the following year. And that's probably what we'll see coming into 2016. The way I look at it is ships do sink. And ships don't sink, though, because they're surrounded by water. They sink because they take in water. And my advice to investors, particularly in the U.S. as you go into an election cycle, don't take in everything around you and have it bring you down, but take a look outside yourself. Go to your notebook of fundamentals, go to your notebook of what really matters, and remember that recessions are not caused by old age or cycles dying out. They're caused by something intervening to take away spending power. And usually those risks are higher commodity prices, we're not seeing that, higher interest rates, we're not seeing that, or a massive bubble that needs to be deflated. And so far, when we look through our checklist, we don't see any of these apparent right now. The fundamentals are not matching up with the fear and anxiety level that we're experiencing. This is Jim Swanson saying thank you.